What's up, everyone? I got someone with a really cool name. His name's Josh, and I'm Josh Krafchick. Welcome back to Unconventional Money Moves. Josh actually started as a boring public accountant, and then in 2008 happened when the world melted down, or as George Bush said, we're in a global meltdown or something like that. And now he's actually founded InvestorData.ai. He's done investor relations in the oil and gas space with Mountain V, and he's a shareholder in a couple of other smaller cap industries. So he definitely took a boring degree and turned it into an unconventional career. So happy to have Josh on. And we were just chatting about that. What was it like in 2008 entering oil and gas? Everyone thought the world was the end, but we need oil for pretty much a lot of things now, and it rebounded quite nicely. And now it's the main thing that you're doing. So walk us through that and welcome to the show.
Thanks, Josh. Great to be here. Wow. So what was it like in 2008? I graduated from Penn State. I had a job offer from PwC. I thought I was going to lose it any minute. The world was melting down. And all of a sudden, oil prices rebounded 6 months later. And I saw a lot of people going down to Bridgeport, West Virginia, and none of them wanted to be down there because it was 2 hours away from the Pittsburgh, Pennsylvania office. And I had just finished my first audit client, which was in coal mining, which was really deep into West Virginia, about 4 hours one way, making that trip twice a week for probably about a year straight. And I got really into coal mining, and then the coal mining industry blew up. Mainly because of Massey coal fire. That was a very monumental fire that had a systemic impact on the industry. And so I see all of these people going down to West Virginia every week. I find out they're down there for oil and gas. None of them want to be there. I wanted to be there. So I raised my hand real high and was the only person asking. And I took over as much as I could as far as being like one of the lead auditors down there. I learned the business inside and out, like the back of my hand within 6 months. I was a big part of helping review their financial statements for 36 master limited partnerships. I'm sorry, not master limited partnerships. They were just LLPs. They weren't MLPs. And I was a big part of helping them get compliant, reviewed, and I just learned the industry like the back of my hand. And at the same time, I'd been investing in a company called Rex Energy, which was a penny stock. And penny stocks were way different in 2008, even up to like 2014, 15 than they are today. This was a great penny stock. And the first thing I'll tell everybody, I got really lucky. Right place, right time. Because they IPO'd in 2008, and I got in shortly after. They IPO'd in the town that I had just gone and graduated college from, Penn State. So they IPO'd in State College. And they were at the forefront of the Marcellus shale boom, but for the lower middle market. In that case, it was a small cap company. I watched the stock rise tremendously and made a lot of money off of that. And it was all luck. Nothing more to it than luck. And then when I rolled off PDC Energy, at that time, they were about an $800 million market cap company. And after my, I wasn't the top auditor, I was a junior guy, but after my cool off period or whatever, then I bought the stock up. I just took every dollar I had and I bought both those stocks. And PDC Energy, fast forward, sold their company to Chevron last year for, I forget if it was 6.7 billion or 7.6 billion, one of the two. But that's what it was like. I got in my car every single morning. I drove down to Bridgeport, West Virginia on Mondays, and I drove back on Fridays. I neglected my social life for about 2.5 years, and I wouldn't have done it any other way. I learned everything I could. Yeah, it was cool. It's cool. It's cool. I mean, I just remember getting on the road in my little Volvo S40, which I was so psyched about at the time. But I remember getting on the road every Monday, driving down, and I get on the road at like 5 a.m. I wanted to beat everybody to the office. And you get to Bridgeport, and all of a sudden there's just massive trucks, Halliburton. I mean, they were drilling like crazy. Chesapeake was drilling like crazy. Penn Energy, I mean, all these companies were drilling just ridiculous amounts of what was called an unconventional well. So a conventional well means you identify the surface that you want to drill, and then you just go straight down. There's more to it than that, but it's a lot cheaper to drill that way. And that's how oil and gas was always drilled. Well, new technology occurred that really opened up a lot of opportunity into what would be like harder to drill natural gas pockets. So the Marcellus shale. and anything really in the Appalachian Basin, where pockets had good deposits of oil in West Virginia and in Ohio, and other pockets had just massive amounts of gas, like in Pennsylvania. Same in West Virginia and Kentucky too. Same in Virginia. I mean, the deeper you go down into the Appalachian Basin, the more just concentrated pockets of gas, like massive pockets of gas. But it's hard to operate down there because you've got a lot of really large landowners. So, it was really cool to get back involved with Mountain View Oil and Gas, who, in a region in oil and gas, the Northeast, where there was a lot of consolidation that occurred. I mean, I watched EQT when I graduated college in 2008. They were maybe a $2.5 to $3 billion market cap company. Now they are the largest natural gas company in America, if I'm not mistaken. And I watched Tony Bryce go.
EQT is what?
EQT, they're a 35 to $40 billion market cap company, and I believe they're the largest natural gas company in America.
Mm.
If not the largest, the second largest. So, and the largest in the Northeast.
Yeah, in 2020, when everything shut down, like literally dirt was more expensive than oil at one point. And I looked at that, I was like, there's no way this is sustainable. This is just a, shift in the wrong direction for a point of time.
Here's what happened. America and the world are fueled by greed, unfortunately. So anytime you see a drastic spike downward in the commodity price, it's being manipulated by one of two factors. Either banks that are hedging the commodity that are having some sort of massive event where they called it wrong, or they called it right, one of the two. Or you have the actual physical trades being diluted or suppressed by supply. Now, supply gets suppressed by regulation. It gets diluted by super PACs like OPEC and now OPEC Plus. And where we've seen a lot of interesting events globally, because oil and gas are the most complex supply chains in the world. Oil is a physical liquid, so you can transport it from point A to point P and globally. Natural gas can be liquefied, and even if it's not liquefied, if it's compressed, it can still be transported. But we're talking a lot of infrastructure costs, both from a port that exports it and a port that receives it, and then infrastructure costs internally within countries. And then we're talking about sanctions between countries that disallow certain countries to trade with one another. And then we talk about world war events, and it all is intertwined, And so back in 2015-16, which was a very interesting time, because OPEC at that time, primarily driven by Saudi Arabia, was more dominant or more influential to the global oil price than America was. America had at one point 1,600 rigs running in just West Texas and the Permian Basin around that time. Prices got driven down by both groups to a point that was still considered break even at $43 a barrel. And that suppressed institutional and retail capital into oil and gas, which created the phenomenon that we're having right now. Through all that, a lot of consolidation occurred, definitely in the Northeast, down to maybe let's say 80 to 100 relevant operators, and in West Texas, down to, let's say, about 450 relevant operators. So, the window's tightened, but America is still a privatized market in the sense that oil and gas is not state-owned and run like it is in other countries like China and Brazil, other parts of South America, where So, back in 2015, 16, when, there was a lot of greed being fueled not only by OPEC, which at that time was predominantly their production was predominantly driven by Saudi Arabia, but within the United States too. I mean, we had 15 to 1600 rigs running at that point in time, just in West Texas alone in the Permian Basin, which is considered to be one of the most prolific, if not the most prolific oil basins in the world. And today that basin is producing anywhere between 5 to 5.5 million barrels of oil a day. So, at that time, the price got driven down to what was considered to be, and still is, the break-even price for oil at around like $40 to $43, and it stayed there for quite some time. And while it was there, that drove a lot of I would call it more speculative institutional capital out of the market. Speculative institutional capital was focused on where multi-billion-dollar events would occur 10 to maybe 15 years from now, and they were betting against regulation changing in America in states like New York, where fracking was banned. I can't remember when that was. I want to say it was around like maybe the 2008, 2010, 2012 era, because you still can drill natural gas wells in New York. You just have to drill them conventionally and not by means of lateral unconventional drilling. And that means you can't frack. It means you can't fully exploit the reserve basis. So therefore, you're limited as far as your economical return on a more inefficient drilling strategy and cycle. So, oil and gas are the most complex and hard to predict markets. So when you see price declines all the way down to what was just ridiculous, nobody was going to give away oil for $20. Like, you just don't do that. You just find ways to store more of it. And if you're able to purchase oil, which you probably aren't, I mean, that price was ridiculous. Nobody was trading oil and saying, hey, here, let me pay you $20 to take my oil away. Nobody was doing that. Like, nobody. And that's why the price corrected relatively quick. But that was definitely some sort of artificial manipulation, most likely driven by hedging instruments. And hedging instruments are used by banks to either make money or to protect themselves from volatility, as oil and gas prices are constantly fluctuating. So,
yeah, I remember in like 2015, 2016, Berkshire took like a position in Kinder Morgan, and then they got out of that quite quickly. And then fast forward almost 10 years later, now they own more than 25% of Occidental Petroleum, which ended up buying Anadarko Petroleum and merging. So obviously there's something going on there. And
this is where it's really important to understand. Oil and gas are literally three words, right? And if you remove and, it's two words that represent a variety of different ways to make money in the industry. So number one is exploration and production. You're going out, you're acquiring minerals or leases or production, and you're determining how to best monetize that by either drilling or re-engineering. And there's many different ways to invest in that. Then there's a little industry that no one really talks about that we've been very successful in. We've also been very successful in E&P in the private lower middle markets, especially with companies like Mountain V. Mountain V is one of the most spectacular examples of a de-risked oil and gas investment strategy that allows you an actual 3.2 to 3.7 multiple on invested capital. So for every $1 million you invest, you'll return 3.2 to 3.7 million over the life of that investment, which could be as long as 30 to 40 years. And number two, that fund is actually offering a direct participation with an operator. So there's no layer of management or private equity. It's a direct to operator. And you're purchasing fractional working interest. Okay, so fractional ownership or working interest in wells that already have production, that we've already acquired, and that are prime and have already been vetted to be re-engineered by our third-party engineering groups and reserve analysis reports. So this is with an operator that has a track record of 30 years, 30 acquisitions and 16 divestitures. We have a real $200 million in PV10, which is verifiable and certified by a petroleum engineer, third party. The company is extremely strong performing. We've received a $200 million co-investment commitment. That's a hard commitment from a very large coal mining family office that's based out of Europe, Western Europe.
Mm-hmm.
We are opening our fund within the next 2 weeks, open to retail, so accredited investors, registered investment advisors, tax consultants. They're all reviewing our fund, and we're obviously open to any conversation. Minimum investment is $100,000. And the beauty of investing directly with an operator in oil and gas is that in the first year, you'll get to write off almost 80% of the amount invested. So if you invest 100 grand, if you invest $1 million, 80% of that can be written off through the IDC tax credit. And then from there, into perpetuity, as you receive a check for every single month that oil and gas well produces, into perpetuity, you're also subject to the depletion allowance, which pretty much offsets any income that you have. Now, these investments are not only highly liquid, but they also allow for a fast return on capital. We typically target an 18-month return on capital. That's what we feel comfortable with. 18, 24 months, those are good returns on capital. So call it, we're targeting a 30% annual return. And again, that multiple invested on capital, 3.2 to 3.7. So for every 100,000 or every million, we'll return 3.2 million. I'm sorry, 320,000 to 3.2 million, if not more. Now, the second fund that we've latched onto that we're really, really, really in love with is also the second fund of the sponsor, and that's for energy finance partners. And what they've done is they've gone and bought working interest and leveraged their capital calls or existing capital calls across a variety of operators, multi-basin, not just focused on the Permian. These are major operators. These are operators like Newborn, ConocoPhillips, operators that a normal individual or a normal investor, regardless of their sophistication, would not be able to invest directly into the wellhead. This is their second fund. It's a $50 million fund, and it's run by Greg Pletz and Samina, two very accomplished fund sponsors in the lower middle market. It's a tremendous fund that offers the exact same tax benefits. So 70 to 80% of your investment in year one, which constitutes the IDC tax credit, can be written off in that first year. And then you're subject to the depletion allowance to offset future year incomes. Again, targeting about an 18 to 24 month full return on capital, targeting about 25, 28, 30% annual IRR returns. This fund is more primed towards a liquidation event, meaning that the positions more than likely will get liquidated or purchased in a secondary market, which also yields a relatively fast return to the investor. What that means is that, let's say Newborn drilled a well and somebody wanted to come in and buy that well at a premium to market. Newborn would then sell it to that individual, that investor, that party. Could be an insurance company. And the proceeds or profit get distributed between the operator and the investor. So this is a great institutional fund, lower middle market, that yields those same types of returns.
You mentioned coal earlier. I've been doing a lot of reading about metallurgical coal, and recently Nippon Steel got approval by shareholders of U.S. Steel to buy them out. Do you know anything about that sort of deal?
What I'll say is this. My experience in coal was very, very early on. So let's call it about 2009 to 2010. I was the lead auditor at PwC for a little small coal miner and brokerage company. So I was on the smaller side. What I would say is that I know steam coal a little bit better than metallurgical coal. And I'm from Pittsburgh. I've got a lot of friends that grew up around the coal industry with family businesses. I'm not a coal mining expert by any means. All I can say is that if you look at energy stocks or coal mining stocks over the past 18 months, they've been some of the best performing. So,
right. Is there any relation between coal and what you're doing in the oil and gas, or are they completely separate?
Tons. So especially when you get into Kentucky and West Virginia, and then in the foothill of Virginia, and then into Tennessee. And these are very unexploited areas that majors have gone and dipped their toe and had massive success, but have unfortunately fallen victim to very large landowners and mineral owners that want more juice. And the public company sees it as uneconomical to provide that. So coal bed methane is what we're sitting on. And that's very wet, rich gas. And we're sitting on over 300,000 mineral and surface acres of coal bed methane with Mountain View Oil and Gas. The firm was started in 1994 by Mike Shaver and his dad. And today, the company, fast forward, has a real PV10 of 200 million. It's almost 90% natural gas focused. We're producing natural gas per MCFE as low as $1.10, which allows us to not only survive in what's called depressed price markets like we're in, where the MCFE is trading at Henry Hub at about 2 to 250 an MCFE. We're a very overhead light company. We only have 90 employees. Okay, we're sitting on 300,000 acres, fully owned, both surface and mineral rights. We own 3,500 wells. You could consider us a mini version of Diversified. We're based out of Buckhannon, West Virginia. We're formerly headquartered out of Bridgeport, West Virginia. Mike Shaver has built an incredible company. And having Ganesh come on as the CFO has been just a dream come true for an investor. That's all I can say, because the company already had the infrastructure to appeal to retail and institutional markets. But Ganesh comes with a world of experience in the financial worlds, having worked at companies like CNX and Consol Energy. So Ganesh has really just strengthened the bench that Mike Shaver built.
Yeah, and a lot of people may believe like, hey, I'm gonna buy this penny stock because it's at a penny, and if it goes to 2 pennies, now I make 100%. But it seems like you're more in the like smaller cap space, meaning a small cap company could still be worth a few $1 billion. Do you have a specific criteria on what your process is for evaluating a good company that is in mainstream?
Yeah, absolutely. So number one, Mountain V is a private company. If we go public, we're going to go public on the New York Stock Exchange, and we'll more than likely you want to go with the following 2 advisors. Marcus Lown, phenomenal, just one of the best old school Wall Street investment bankers, so far ahead of his time, a master of crowdfund. In fact, we're his company SkyQuery, he's taking public on the NASDAQ later this year. That company is doing $65 million a year in revenue. It's already approved. All the shelf filings are approved by the SEC. They're just consummating a quick $20 million round ahead of the IPO. We're expecting a blockbuster IPO, $100 million valuation. We are a shareholder. The second individual that we would like to appoint would be Taglich Brothers, Mike Taglich. He's taken 30 companies on the stock exchange. And so what we're more than likely going to do is integrate a full model where we take Button Energy, which has about 5,800 customers in Northeast Pennsylvania for propane distribution, and has the ability to expand throughout Northeast Pennsylvania and into New Jersey and onto Long Island, where I live. We really like this propane distribution model. The propane distributors are acquiring propane for about 80 to 90 cents off the rack per gallon. In West Virginia, in Kentucky, we're able to produce propane for as little as 20 cents a gallon economically. Both locations have rail sidings. We're in the process right now of evaluating how many rail cars we want to buy, and then increasing our storage both on the Kentucky, West Virginia side as well as the Pennsylvania side. This will allow us to circumvent having to develop midstream assets. Back to your point about Warren Buffett, Kinder Morgan, midstream company. And guess what? Tons of money has been made in midstream, but it's a very institutional game because the projects are massive. They require a lot of capital. He then went into Occidental Petroleum. Occidental Petroleum, through the purchase of Crown Quest, will become, and we're tracking that Crown Quest acquisition every day, and I'll explain why in a second, Crown Quest, Crown Rock, um, Crown, they that's going to be most likely like an 11 to 12 billion dollar transaction, and it's all over the news right now. But that transaction, if completed, will put Occidental Petroleum in the position to be the largest Permian operator, Permian Basin operator, West Texas. Now we're in oil field services, so we also perform the services and construction side of oil and gas for the major operators in West Texas. Back to your question about penny stock, through my mentor, Marcus Lown, and through my other mentors, Sean Rye and Chris Bishop, we recently took ATC Energy Services, a $15 million a year revenue, $2 million EBITDA company that does oil field construction in the Permian Basin. We focus on dirt work, and we do 70% of our work with Crown Quest. Now, Crown Quest, if they have an $11 billion liquidation event, they're just going to open up Crown Quest too. They've already got the office open, and they're always drilling. They've always got 8 rigs out in the field, regardless of what the commodity price is. They've been a great customer of ours. This also opens the door for us to go and get an Occidental Petroleum MSA and be a service provider for Occidental Petroleum. So that stock right now, we're expecting Q2 earnings to be filed within the next 2 weeks. Within the next 3 to 4 weeks, we're expecting a clean audit opinion from Frucci, who is our designated auditor. That will allow us to file what's called a Reg CF and open the door for a $5 million crowd fund to start. It will also allow us to file for our uplist to the OTCQB, which is a 6-month process. We have not invested a dime into IR or investor relations yet. And we want to make sure that the audit comes back so that we time our IR. I would also say, too, that at this point in time, there's no speculation on my side, because when I get involved in a penny stock, I'm taking over that stock. I'm making sure we have a clear path to uplist to the NASDAQ. I'm making sure we have the right team. I'm making sure that we have brought in the right investment bank counsel. And when I say that, it's not just me. It's really under the governance of Marcus Lown and myself to determine which direction we're taking all of these companies, because there's no one-size-fits-all approach to raising capital or investing. There's not.
Well, Josh, if anyone's learned anything, it's find something, dive deep into it, and learn everything you can about it, and just do it. So happy to have you on. We'll see everyone next time. Bye, everyone.